Goldman Sachs just released some zero DTE option information, and it's using data from the SIBO. Actually, one of our viewers sent a Reddit channel over to me with the link, and it's some pretty interesting information. So I'm going to walk through what they came across with you guys. And then at the end of the video, I want to walk through how we could integrate this into our trading decision cycle, because there's some usable information in here. So first off, let's take a look at what we have going on. This is where it's from, is Vol Signals. I have it zoomed all the way in so it's easier for you to see. And this is the person that posted it. So thank you for posting that. And let's get into it. So this is talking about SPX indexed option volume by customer, and 49% are large trades through retail brokers, which that's actually kind of interesting to me, just because I wouldn't expect large trades to be coming through there primarily as compared to the small trades, which is 33%. But, you know, large, small, I don't know how they break that down on Goldman Sachs. I'm sure it's common nomenclature for them, but I don't know the difference. If we look down here at stock equivalent traded by investment vehicle, the main thing to highlight here is the change in the colors. So in this case, you can see single stock shares started to spike up. And as you probably would have guessed, this is corresponding beautifully with what we saw during COVID, AKA it's right when COVID was kicking off and a lot of retail traders started entering the markets. The other thing to highlight here is the expansion of green volume, which is index options. And then the other thing is just the expansion of overall volume. So this back in 2011 was hovering around, you know, maybe $500 billion, and post it's like 1.25. So just a lot of increase in volume. Now we have percentage of stock equivalents trades by investment vehicle. This is a 10-day average, note that's a risk. And again, I want you to take a look at the kind of changing of the composition of the colors. So specifically, if you look at the index options, notice how in here it was maybe hovering around 10% of the volume, and it's expanded to about 18% of the volume, something like that. So big expansion in index options. If you look at single stock shares, not too much of a change. The other thing that had a meaningful change is ETF options, though. If you take a look at where it was sitting here in 2020, and then where it's expanded to towards the end of February 2023. So these two have really started expanding a lot of the percentage of volume. Then we have the distribution of SPX volume. The main thing to note here is notice the dark blue is less than 24 hours. Notice the explosion of that. Again, from 2020, this is all very clearly tied to people starting to trade during COVID, but then this has continued to cascade up pretty meaningfully into 2023. Whereas if you take a look at something like 1 month plus, that's actually taken quite a haircut. As a percentage of overall volume, it's contracted meaningfully. Same thing with 1 week to 1 month. You're gonna see a very clear focusing of less than a week, which is kind of this light blue and the dark blue. Down here, buying 1-day straddles has been slightly profitable. You can see kind of the skew here. Realistically, when we're buying a straddle, we just want it to move. And this doesn't surprise me, especially during a bear market where we get some larger moves. And we're going to get to some of those in just a second to kind of quantify around this. But it's an important note because this typically is not the case over longer term timeframes when you think of things like variance risk premiums. But during bear markets, things behave slightly differently. So if you apply bull market strategies and rules to bear markets, not shockingly, you're not going to get a great result. And that's the same thing even for net delta neutral option strategies. And I want to talk about that a little bit more in a minute. Now we have daily zero DTE options volume, and it splits it out between calls and puts. And you can see nothing necessarily too shocking here. We have periods where one is favored over the other, but otherwise nothing that I would focus on too much. And then this is kind of another view, proportion of daily zero DTE options, calls and puts. And it's, you know, as a percentage of notional value, it's still not 50-50. It ebbs and flows a little bit in favor of one or the other. All right, now down here to SPX daily absolute move versus the 1-day straddle prices. This is very important. So if you are a variance risk premium trader, we want to see the straddle price being priced greater than the absolute move. And this is essentially where you make your money. If you're trading short-term variance risk premiums, essentially this is saying if the straddle price is more expensive than the absolute move, it means that the market was expecting a bigger move, pricing the options for a bigger move, and we didn't get it, meaning you probably would have made money there. Now, notice though, as we take a look at these bars, we have the dark blue is the straddle and the light blue is SPX. We have a couple instances where the dark blue bars definitely greatly exceed the light blue bars, meaning the straddle price greatly exceeds the SPX price. None of them are to the degree or scale that we see the inverse. And none of this is surprising because this is looking at the end of last year into this year, 2023, a bear market. So when you look at things like 6 Jan, notice this variance where the absolute move was massive. It was above 2%, probably 2.4%, compared to the straddle price, which was less than 1%. Giant tail in that data. So from a trading perspective, this is where we can start layering on how we can inform our decision cycles, which is in the current markets. If you are just attempting to capture the variance risk premiums on a structure that you've developed during the bull market, it's not working here and you have to adjust it. One of the things is maybe think about the tails a little bit more when you're attempting to do so. So for example, if we take a look at this chart, which shows us the SPX one-day straddle price minus the absolute move. So this is really showing you this, but in a single day so that you can get a better idea of severity. So there's 23 data points up here in the green, meaning there's 23 occurrences where the straddle was overpriced compared to the one-day move. But then there are 19 data points down here where it's the inverse. The move was greater than the straddle price. Notice the difference in these bars. A lot of these bars hang out right above 0.5%. And down here, there's not as many of them. So what I mean by that is this. There's 10 of them up here in the green where the straddle was overpriced compared to the spot move that was greater than 0.5%. And then there was 6 of them down here. But the average of the data point that exceeded it is much larger for the red, meaning the days that we saw larger SPX moves compared to SPX straddle prices as an average for those bigger moves was much higher. So the severity on these larger SPX moves compared to straddle is meaningful. So this also tells me that this is another tradable event that if you get one of these extremes, that is, you can quantify if you have an intraday move now that is 2% plus, you can create a 5-day average, 10-day average, and then trade the extremes off of that. Now, if we look at trading volume proportions, this is showing us within 1% of closing price, the strike prices. And then the light blue is other strikes. And as you can see, there's definitely a centralization around 1% of closing spot price, meaning we're trading things close to the money. This is no real shock. A lot of it has to do with that's where the money is. And a lot of the stuff they're looking at here straddles, so it doesn't surprise me. Here we have SPX 1-month put call skew. This is something I track regularly, so this is nothing that's really super specific to this slide deck by itself, but nonetheless, it's interesting information because we saw, again, during 21, 22, a lot of bearish positioning, although not super bearish, and then it's been trailing more towards bullish, but still not very bullish. And all in all, you know, I track put call skew pretty closely. But otherwise, I don't think there's anything super impressive on this slide. I do think this one's interesting though, which is SPX intraday volatility compared to close volatility. And the intraday is essentially using average of a handful of different calculation methods. So the Garmin clause, so on and so forth. You can see them all listed here. And in general, they're tracking pretty close to one another, but there are several instances where end of day is actually significantly more overstated compared to intraday. So this is one of the things that I also was talking about, where if you do have the capacity to create a model, at least a loose model, to give you intraday volatility, I was talking to the Discord about this last week, there are some pretty tradable events, especially leading into the end of the day volatility that we've been seeing at least for the past few months. And as you can see, this isn't really that long of a data sample, but specifically from 2022, there are a lot more instances where end of day is much larger than intraday. And then this essentially gives you a cleaner view of that, where that orange line is the mean difference, and then the trailing blue line is the actual difference. And again, looking from 2022 on, there is a pretty meaningful variation here, but nothing else to add in addition to the previous one. So all in all, a lot of really useful information here. If you have variance risk premium tracking strategies, it's still viable, but you have to be way more selective in these kind of markets for the reasons that I just shared. And if you have any questions or anything else that you want to see me dive into, let me know. But overall, trading the extremes is still working pretty well. So until next time, be an outlier. See y'all later. Don't forget, like and subscribe. See you guys.